Welcome back to another quick stock analysis, and today I'll be looking at Johnson & Johnson. Now, today Johnson & Johnson has had a little bit of a drop. This week it's down about 2.4%, and that's on the news that Johnson & Johnson has paused its vaccine because of the blood clots. If you don't know, in the UK, we also have that problem with AstraZeneca. The AstraZeneca vaccine is essentially being banned in Europe because it might cause some blood clots. It's something like 6 in 600 million or something. I haven't got the exact fact, but this does mean a lot, and Johnson & Johnson is having a very similar story in the US. This has caused the FDA to say, okay, hold on, let's do a bit more study and find out if the Johnson & Johnson vaccine is really that bad. And this has sent some bad news through Johnson & Johnson, causing a 2.4% sell-off. However, Johnson & Johnson was never actually going to make any money on its vaccine. It was never supposed to produce earnings from it, or at least in the short term it wasn't at all. Maybe in the long term it was going to make something, but we do know that Johnson & Johnson was never going to make any more money from the vaccine, or at least very little money from the vaccine, so this shouldn't really impact its earnings. So, has the market now reacted in an irrational way, and is there a buying opportunity on Johnson & Johnson right now? Looking at Johnson & Johnson's earnings graph, it is a ridiculously good compounder. There is a very good reason why Johnson & Johnson trades at an 18 price to free cash flow on a normal day. So this company does always trade at a very slight premium to its cash flow. This is probably something to do with the 2.53 very well protected dividend, a AAA credit rating, and a long-term debt to capital of 33%. These are all very good starting points for Johnson & Johnson. Going through Johnson & Johnson's fundamentals here on fund graphs, we have a current ratio of 1.21, which is not particularly high. Usually I would like to see it more over 1.5. 1.5 is generally the minimum I'm looking at, and it is slowly declining over the past few years. Current ratio is a company's ability to pay off its short-term liabilities. Usually over 1, it means a company can just about pay off all of its debts. It's got enough cash on hand to pay off its short-term debts. Johnson & Johnson is 1.2, so it's just over that, but only just. Shares have nicely been decreasing over the long term. Over 10 years, it did have this blip in 2014 where it obviously raised some capital for an acquisition. And going on 5 years, we've seen a nice steady decline of -1%. So this company does have an effective share buyback program, and your dollars that are going into this company when you're buying a share are getting more valuable over the years. Revenue growth over the past 10 years is going up by 3%. This is expected. This is very slow growth, but it is going up, which is very good. And over the past 5 years, we're going up 3.3%. So this has got some good revenue growth. It's a very old, long-standing company. It's a very mature company paying a dividend. So growth right now isn't going to be in double digits. It's in 3.3%. This is very good for a company this old. EBITDA growth is looking pretty good as well, I think. Yep, over the past 10 years, 3.4% EBITDA growth. This company is profitable, very good. Not always what you get from those dividend reinvestment companies. And over the past 5 years, we have seen EBITDA growth, but in 2020, it dropped about 3%. 2020 being a pandemic year, we can definitely see that Johnson & Johnson's consumer products would have taken a hit, but also its regular medications might have taken a bit of a hit as well. Taking a look at total debt over the past 10 years, the debt is growing at a CAGR of 9.4%. And over the past 5 years, growing even more. So this company is taking on a lot of debt. The debt to capital was about 30%, sorry, as I remember. So it's not super dangerous right now, but we remember that this current ratio was very, very tight. This company is going to get a little bit more sketchy on its current ratio if it's taking in high interest short-term debt. Obviously, it needed to take something out in 2020. I'm not actually sure why, and I definitely should know. But for some reason, it has issued some bonds. It looks like about 7-8 billion in bonds in 2020. I'd say that was to cover the pandemic year, but I'm not entirely sure. Most importantly about Johnson & Johnson is it is a cash generating machine. 20 billion in 2020 of free cash flow, growing at a rate of 1.4% on a bad year. So on a bad year, it still grew its cash. Very, very good. Looking at the 5-year table, free cash flow growth of 5.1% year on year, which is very good. 1.4% growth, like you said, in 2020. And previously to that, in 2019, on a good year, it was 7.5% growth. This is good free cash flow growth from a old, staggered company. Earnings over the past 10 years have only been growing at 8%, pretty much on average. It's had that bad 7% drop in 2020, but now it looks to be really picking up, with analyst estimates at 18% earnings growth next year, 8% the year after, and 6% the year after that. Free cash flow is pretty much the same as well. Like I said, it trades at a price to free cash flow of 18 on average. It would be very nice to catch it while it was under this area right there, because instead of from say 2002 to now, you would have seen a 6.8% return year on year. That's quite slow. It's in line with the S&P 500, but it is quite slow. But instead of that, if you caught it under its normal value range, you would have seen 11.6% return. So if you're catching this company while it's underneath its sort of average value, you are going to see double the return. This is the importance of why we look at valuation on such good companies. Having a look at 2021, 16 analysts believe that Johnson & Johnson will grow its earnings by 18%. Remember, this isn't that it's growing at a rate of 18%. This is just it's going to be up 18% from its minus 7% last year. Going forward, 17 analysts believe it's going to grow 8% after that, that's more likely. And then 6 and 6 as further estimates go onto 2024. And if this company continues to trade at a PE ratio of 16, you can expect a total annual return of 7.2% year on year. And that's a full return, including dividends, of 29.83%. That's up until 2024. If you're looking at what the analysts think. And that's if everybody still rates Johnson & Johnson at a PE of 17, which, to be honest with you, with the stupid human behavior out there of the safety and comfort of Johnson & Johnson, it's very likely that it will remain at this sort of PE. It's very unlikely that it's going to drop down to a sort of 12 PE. But if it did drop down to a 12 PE, you would lose 2.68% in total by 2024. And that would be an average return of minus 0.73. So every year you'll lose 0.73 on your money if Johnson & Johnson doesn't perform very well. That is based on a current share price of 159 and an ending share price of 138. Remember, at a PE of roughly 16.5, you've got a share price of 190. And if it stays at that lovely 18 PE, you've got a share price of $207. Going on to the custom calculator, let's be nasty and let's say this company trades at a PE of 15 by 2026, and we'll keep it at analyst estimates. So it's going to drop 7% next year. It's going to go up 18% the year after that, 8% the year after that, and then we're going to keep it at a nice steady 6% up until 2026. With that in mind, and to be fair, that is quite a harsh scenario, you're going to see a return of 6.01% year on year. This to me is my normal scenario. This is what I would nicely expect of Johnson & Johnson over the next couple of years. Let's say things go pretty badly over the next few years and it only grows at a rate of 4% going forward. It also detracts back down to a PE of 15. In this case, the dividend does save you and you get a total return of 2.01%. You're still making some money. Arguably, you're still making over inflation as well. And this is possibly in one of the worst kind of situations for Johnson & Johnson. This is actually really solidifying my belief in Johnson & Johnson that actually it's quite a good investment. And for the sake of it, let's stay at a best case scenario. Let's say that Johnson & Johnson stays at a PE ratio of 18 and also grows at 6% year on year. In that case, by 2026, you have a final share price of 205.03 and a total annual return year on year of 6.8%, arguably in line with the S&P 500, and this would be considered as a pretty good return on Johnson & Johnson. So, what would I personally like to see right now? Johnson & Johnson is trading at a price of $159 and it is down 2.4% on the week due to that weird news about the vaccine. This is probably an irrational drop due to people not understanding the benefits of the vaccine for Johnson & Johnson, which as far as I can tell is purely media driven, but also cash driven by the government funding that came in. That was the one-off payment for Johnson & Johnson to develop this vaccine. After that, like I said, it doesn't make any profit after that. So what price would I really like to pay for it right now? And one of the things I'm trying to do is, in the worst case scenario, I'm trying to just beat inflation. As long as I don't lose money in the long term, I'm happy with that. But ideally, because I'm investing in individual stocks, I would like to beat the S&P 500, because otherwise, why wouldn't I just be in index funds? With this in mind, Johnson & Johnson could drop to $150, and it still probably wouldn't get me a good 10% return. I probably need to go even lower to something like $145, and if I did drop that low, still not making me any significant return. And this is still at that really good 18 PE. And in fact, at $140, that's where we start to see that 10% return come in for Johnson & Johnson. So really, I would like this news to go really, really badly for Johnson & Johnson right now, because I know this company is still growing. I know it's got that safe dividend. I know it's got excellent cash flow generation. And based on my own qualitative data, I know it's got a good product range still. I know it's got a few generics, and I do know that it has a reasonable pipe. It's nothing really too good to shout about. It's got some drugs coming through that it can really profit off in the future. But to get that nice, safe-ish 10% return, I would be looking for a price of around $140. To be honest with you, we're not that far off it at $159. It is only really slightly overvalued at this point. And if it's really going to get some bad news coming, we could see that price coming down into that area where I'm thinking, oh, I could maybe top up a bit of Johnson & Johnson right here. I've even let my own valuations go a little bit as well, with $145.05 as my average price on Johnson & Johnson. I'm willing to let this price come down to about $145. If I can get this company under $145, I'll probably buy a bit more. With Johnson & Johnson, I think it's pretty close to a reasonable valuation. And if we can just see what this news does to the short-term price, maybe this company might just come back down into the reasonable levels that I'd like to buy this company. Just going to take a quick look at Genuine Impact, actually, just to see what that says. I don't usually look at Genuine Impact for US companies. So Genuine Impact rates Johnson & Johnson as a very high quality company, and very interesting that they've put down a medium on their financial strength there. That would be the current ratio that I mentioned earlier. But Genuine Impact currently considers Johnson & Johnson as expensive. A medium valuation on its income statement, and it's saying it's expensive based on its value balance sheet, which I'm guessing is Genuine Impact looking at the price to book value, something that I really don't look for in a company. I don't like looking at price to book, but I can understand why there's a lot of people that do look at it. What's most important to me is that Genuine Impact does consider Johnson & Johnson to be cheap based on its cash flow, and that is something that I am looking for. So Genuine Impact has kind of agreed with me on this one, and it's very interesting. Thank you very much for watching, guys, and if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.